Welcome back to the channel, everyone. And in this video, we're going to go over 6 stocks to take a look at this week. We are still in the heart of earnings season, and we have some major companies sharing their latest report over the next few trading days. We have some leaders in the tech space and some nice blue chip dividend paying stocks as well. So today we're going to go over each of the companies, take a look at what analysts are predicting for their latest earnings, take a look at their historical growth, and some future expectations for the growth over the next 3 to 5 years. So definitely take a look at all these companies throughout this next week. And last week, even after some major companies reported rock solid earnings, beating on both revenue and earnings expectations, the share prices still took a huge decline. So over the next few days, if any of these companies report a very strong quarter and have strong positive outlook, we still may see a decline in share price because of how volatile the market has been lately, making a great buying opportunity. But before we jump in to the first stock in today's video, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and sell, and any major market news or headlines. So please hit the like button, subscribe for daily videos, and every single Sunday, we go over the top companies to keep on your watch list for the upcoming trading week. And these are usually the companies who report earnings, have a product launch, an investor day presentation, or any major event that will impact the share price over the short term. So thank you for watching, and we're going to jump right in to the first company in today's video, which is Amazon. They are one of the largest companies in the world with a current market cap of 1.6 trillion. And over the past year, their share price is up more than 72%. But if we take a look at the 6-month chart, from their high set back in early September 2020, the company is actually down more than 9%. So a slight decline in somewhat trading sideways over the past few months. And they report their latest earnings this week on February 2nd, 2021. We have a revenue estimate of $119 billion with earnings per share of $7. And if we take a look, over the past 90 days, analysts have been reducing their earnings per share expectation 30 different times. So they are getting more bearish on this latest report from Amazon. And if we take a look at their history, they've beaten expectations on 3 of the past 4 quarters, and we're only expecting 8% year-over-year growth over this 4th quarter report. So it'll be very interesting to see how Amazon reports, because these analysts have been reducing their expectation, and if they miss or only slightly beat, we may see the share price take a huge drop like we saw last week, and this share price may be trading at a very attractive level. And if we take a look, Amazon continues to grow at a massive rate year over year. 5 years ago, they brought in just over $100 billion of total revenue, compared to where they are today at just under $350 billion over the trailing 12 months. And each and every year, their total top line continues to expand and grow at an exponential rate. And before, Amazon was not really worried about profits, but now they are bumping up their bottom line with over $17.3 billion of total net income over the trailing 12 months. And analysts have strong predictions for this company over the next few years, and it is expected to grow by close to 33% per year over the next 5 years in the future. And at this current level, it is considered a strong buy, coming in at a 1.7, and the short-term price target still shows some massive upside. The current level of $3,200 per share is well below the 12-month expectation of over $3,800. So analysts are very bullish on Amazon over the next few years, but over this latest report, we have actually seen a decrease in earnings per share expectations. So this is a really large company that I'm really looking forward to see how they report over the past 90 days, considering we saw companies like Apple, Microsoft, and Facebook all post very strong earnings. So Amazon was the first big tech giant to take a look at this week. And now if we move over to the second stock in today's video, we have Google. They currently trade for around $1,800 per share and are up more than 25% on the 1-year chart. Their current market cap is $1.24 trillion, and they're trading at a very reasonable forward PE of just over 35 for this big tech leader. And I personally believe Google is one of the strongest, if not the strongest company in the world. They are the powerhouse behind so much of the operations that every single business uses every single day. And they report earnings this week as well on the same day as Amazon. We have a revenue estimate of $52.8 billion with earnings per share of just under $16. And over the past 90 days, we've seen 20 upward revisions of EPS expectations and only one single downward revision. So analysts are getting more bullish on this latest report from Google. And if we take a look, they've beaten analyst expectations for earnings 3 of the previous 4 quarters, and we're only expecting a slight 4% year-over-year growth over this latest report. But if we take a quick look at Google's financial statements, they are another powerhouse that continues to grow and expand at a massive rate. Each and every year, their top-line revenue continues to perform extremely well, with over $170 billion of total revenue over the past year. And if we take a look at their net income, this is a very profitable business as well. More than $35 billion of total net income over the past year. And taking a look at their balance sheet, they have a huge cash position at this current level, sitting at over $132 billion. They have so much cash and short-term investments available to do research and development, make acquisitions, or really do anything they want. $132 billion is an insane amount of cash to hold at any point in time. And if we take a look moving forward, analysts are very bullish for this company down the road. Over the next 5 years, we're expecting close to 17% per year growth, and it is currently rated as a strong buy, coming in at a 1.8. And the current share price of just over $1,800 sits nicely below the 12-month expectation of closer to $2,000 per share. So we all know Google, we use them every single day. They are the powerhouse behind so much of the internet, and as a whole, I believe this company is going to be around for decades in the future. They have such strong operations, nice profit margins, great financials, and really looking forward to their report over this next week. And now we're going to move right on to the third company in today's video, which is PayPal. Ticker PYPL. They currently trade around $234 per share and have grown by just over 100% over the trailing 12 months. But over the past week, when the market saw some red, this company declined just over 7%. Their current market cap is $274 billion, and this is a leader in the financial tech sector. They are a household name, they are trusted by hundreds of millions of people, and as a whole, PayPal is expected to grow at an exponential rate for decades in the future because of their high profit margins, the strong brand loyalty, and the growth of the digital and e-commerce world. And if we take a look, they continue to innovate and come out with some very strong new features like their new cryptocurrency service. PayPal announced late in 2020 that they will allow users to buy, hold, and sell crypto within their PayPal wallet. And what's very important is that they are now enabling users starting 2021 to actually use PayPal in over 26 million digital retailers to buy and sell products and services. So PayPal will actually allow users to use Bitcoin in transactions on the marketplace. This is a first. They are a leader in the fintech sector, allowing this new service, and I think it can really bolster up their strong brand loyalty and let them be a first mover in a very innovative space. And if we take a look, they report earnings on February 3rd as well, and we're expecting around $6 billion of total revenue and $1 in earnings per share. And over the past 90 days, we've seen huge downward revisions from analysts for their EPS expectation. No one has been bumping it up, but we've seen 34 downward revisions over the past 3 months. So analysts are actually very bearish over this latest report from PayPal. You can see again over the past 4 quarters, 3 beats and 1 miss, and we're still expecting 16% year-over-year growth over this 4th quarter report. And if we jump over to their income statement, this is another business in the tech space with incredible financials and growth. Each and every year, total revenue continues to reach new highs with over $20 billion over the trailing 12 months. And if we take a look at their net income, they have over $3.1 billion of total income over that same trailing 12 months. And taking a look at the chart, each and every year, it continues to grow like clockwork. So PayPal has some nice profits, and analysts believe they will continue to grow for many years in the future, expecting close to 23% per year growth over the next 5 years. The company is considered a strong buy and sits below the 12-month price target of over $256. So another leader in the tech sector, but primarily focused on financial tech, which is an ever-growing industry, and people are transitioning into these fintech leaders and moving away from the traditional banking system because PayPal and their competitors offer much lower fees and more ease of use. So I like PayPal. I've been bullish on this company for a long time. I've discussed them in a lot of videos and really looking forward to see how they report. And if they see a massive pullback after their earnings, I think this company would be at a very attractive level. And so far in this video, all three of the companies that we've taken a look at were primarily growth stocks that do not pay out a dividend. But moving forward, stocks 4, 5, and 6 in this episode all pay out a dividend to shareholders each and every quarter. And if we move over to the fourth company, we have Qualcomm, ticker QCOM, one of the leaders in the semiconductor space, which currently trades for around $156 per share and is up 77% on the 1-year chart. Their current market cap is $176 billion, and they trade with a forward PE of just over 22, which is at a nice level for a fast-growing tech company. And their current dividend yield is at 1.66%. So they report earnings this week as well, and we're expecting a huge report from Qualcomm. We're expecting $8.25 billion in total revenue with $2.09 of EPS. They report on February 3rd after market close, and over the past 90 days, we have seen 20 upward bumps for EPS expectations. And over the past 4 quarters, Qualcomm has beaten expectations each and every time, and over this latest report, we're expecting 111% year-over-year growth, and moving forward throughout 2021, analysts still have huge earnings expectations. 75% growth, 84, 33.5. So moving forward throughout this next year, huge expectations for the growth of Qualcomm's earnings. And if we take a look, that current dividend yield at 1.66% only makes up around 37% of their total net income, and their 5-year dividend growth rate is at 6.7%. And although their current dividend growth streak only says 1 year, if we take a closer look at their history, back since 2004, they have been growing their dividend over the long term. Except over 2019, they maintained the same payment for 6 quarters, but have recently grown it in 2020. So you can see they do have a long dividend history, just at one point, they maintained it for an extra 2 quarters instead of raising. So overall, still a company with a nice dividend growth history over the past 15 years. And going forward, we're expecting 22% per year growth from this company over the next 5 years, and that is insane. They're currently rated as a buy and sit below the 12-month expectation of $168. So Qualcomm is a company I personally have on my watch list. I like their operations, I think they will continue to grow, and as a whole, this is a dividend-paying tech stock in the semiconductor space that I might add into over the month of February. And the final 2 companies in today's video are not tech stocks. We've taken a look at 4 big tech names, and now we're going to move over into the big pharma space because a lot of those major leaders report this week. And we have 2 companies in particular that you should have on your watch list. And coming in at number 5, we have Pfizer, ticker PFE, currently trading around $35 per share, and the company is down just over 4% over the past year. Their current market cap is just under $200 billion, with a forward PE of only 13.2 and a current dividend yield of 4.35%. Over the past 5 years, the company has seen minimal growth of only 17%, but this company has been providing investors with a nice high dividend over that same timeline. And if we take a look, they report on February 2nd, we have a revenue estimate of $11.3 billion and earnings per share of 46 cents. And if we take a look, they've beaten on 3 of the past 4 quarters, and we're actually expecting a decline over this latest report. So I believe if they miss or even post this record decline of 16% year over year, the company may see a major pullback. And right now, we all know Pfizer is part of the vaccine development and rollout. So hopefully over the long term, this company may see some strong benefits because of those new innovations. But we'll see how it goes. A leader in the big pharma space that I believe a ton of investors all across the world will be looking at over this latest report. And if we take a look, they are a high dividend paying company with a 4.33% dividend yield, and their payout ratio is only around 58%. So a ton of room to reinvest back into the business and grow while continuing to grow out that dividend to investors. Over the past 5 years, we get an average dividend raise of 6.3%, which is not too shabby with such a high starting yield. And for the 2021 fiscal year, analysts are predicting a massive spike in their total revenue and are expecting it to grow by more than 20%. That's huge, and the average analyst expectation for their revenue over this next year is at over $56 billion, which is great to see. And now we're going to jump in to the final stock in today's video, which is another big pharma giant, and that is Merck. Ticker MRK, currently trading around $77 per share, and is actually in the red by more than 11% over the past year. And over the past 5 days, we have seen a pullback of around 5%. Their current market cap is $195 billion, again trading at a nice reasonable PE of just around 12.8, and their current dividend yield is at 3.37%. This company reports earnings as well on February 4th. We're expecting revenue of $12.65 billion and EPS of $1.39. And if we take a look, they've actually beaten analyst expectations over the past 4 quarters, and we're expecting close to 20% growth in EPS year over year. For this big pharma company, they've seen continuous revenue growth each and every year, which is a strong sign. A lot of these leaders are trading flat, not really growing as time goes on, but you can see by the numbers, each and every year the company does expand, not by a massive rate, but growth is growth. And if we take a look, their current dividend yield at 3.37% is fantastic, a nice average or higher end yield with a payout ratio of only 43% of their net income, and they grow at averaging 6.5% growth over the past 5 years. And this company has actually bumped up their dividend growth as of late, and over the trailing 2 years have raised it by at least 10% each time. And they've been growing their dividend for 10 consecutive years, and going forward, we're expecting around 7.5 per year share price growth, plus that over 3% dividend. You're looking at a 10% plus performance over the next 5 years if analysts are correct. And if we take a look, their current buy rating is just about a strong buy, coming in at a 1.9, and their current price of $77 sits well below the 12-month expectation of around 96. I own Merck in my personal portfolio, and this is one of the most undervalued big pharma companies on the market right now. So definitely take a look at Merck and all of the companies we've taken a look at. We started off the video with the market leaders like Amazon, Google, and PayPal. Then we took a look at some dividend-paying companies as well, like Qualcomm, Pfizer, and Merck. So a lot of companies report earnings this week. We're still in the busy part of this quarter with earnings, and I think as a whole, like we saw some red in last week's market, even after strong reports, I think that same trend will happen this week. Even if some of these market leaders report record-breaking numbers, beat analyst expectations for revenue and earnings, we may still see a pullback in the overall market, bringing down the share price of these very strong companies, making huge buying opportunities. So definitely keep that in mind over this next week. These companies are reporting some great earnings, and looking forward to the reports, and I will make future videos updating you on the performance of these big names over the next few days. So thank you for watching, everyone. I am the Gen Z Investor, and see you in tomorrow's video.